Right as the Treasury yield curve has been sending stronger bull signals, there have been even bigger moves in an even more critical market just in the past month, with several key parts of it hitting record lows. And the rest of that market is sending strong signals as well. Interest rate swaps and the swap curve are in many ways even more important than the yield curve. For many inside the Eurodollar, the swap curve is it. This isn't some niche market. It's enormous, and it is tied to basically every fixed income credit product on the planet, not to mention other derivatives. The whole global financial system really starts right here. How the swap market changes the shape of everything around us, whether we know it or not. And because of that, we're going to go over what's happening right now in swaps and swap spreads, what these signals are, but more importantly, we're also going to go over some of the basics so you can understand for yourself what all of this means. These interest rate swaps are quite complicated since, after all, they are derivative contracts. But once you get the basics, understanding what the market is doing and therefore what it is telling you actually becomes really manageable. And it is well worth it because practically the entire monetary and financial system is built up from it. So let's start with some of the basics. We're talking about interest rate swaps, where someone is going to be paying fixed and receiving floating, where another's going to be paying the floating and receiving fixed. So if you're receiving the fixed rate, then you're paying the floating rate. And if you're receiving the floating rate, then you're paying the fixed rate. And the floating rate used to be tied to LIBOR, but now it's mainly SOFR, and don't get me started with all of that. So basically on an interest rate swap, you have two opposing sides. And the interest rate swap contracts can be any maturity, short-term, long-term, and anything in between. So when we're talking about an interest rate swap or an interest rate swap spread, we're quoting the fixed rate for the fixed leg part of the interest rate swap. And the swap spread is comparing that fixed rate quote to the same maturity nominal U.S. Treasury yield. But we're getting a little bit ahead of ourselves here, swap spreads and all that. And before we get into the basics and where swap spreads and swap rates are today, I do want to let you know I will be hosting a live stream next Tuesday, July 23rd, 6 to 8 p.m. It will be a question and answer in honor of our 100th Q&A at Eurodollar University. Eurodollar University members and subscribers will be posing questions to me live, as well as several of my big name, big time guests. I've got Steve Van Meter, George Gammon, Mike Green, Brent Johnson, Eric Bezmajian, Jim Rickards, and our extra special guest, the OG Eurodollar University himself, Emil Kilinowski. The live stream will be next Tuesday, as I said, 6 to 8 p.m. Maybe we'll go a little bit later, all Eastern time. I do hope to see you there. All the details about it, as well as our anniversary sale that is still ongoing, you can find those details at our website, eurodollar.university. Now let's get back to interest rate swaps and interest rate swap spreads. But first the swaps before we get to the spreads. You got to understand interest rate swaps to understand interest rate swap spreads. And there are two major factors that are driving spreads. And I talk about the one pretty much all the time, and that's on the supply side. And the supply side means money dealers. And there are a number of factors that go into how dealers supply these contracts into the marketplace. Their holding of U.S. Treasury coupons, for example, which corresponds with interest rate swaps and especially swap spreads. That means balance sheet capacity, which is the biggest one of all of the factors, which is one of the reasons why we pay such close attention to swap spreads in particular, because they can tell us something very important about the monetary conditions, the balance sheet capacities of dealers in the system. That's what I often talk about. It's tied to arbitrage and things that I've talked about before. But basically the supply side, as I said, sets the relative level to U.S. Treasuries and to some degree the changes in spreads around that level. And I've mentioned, and we've gone over these before. So today I want to focus on the other side, the other factor, the other primary fundamental factor, which is basically the demand for hedging. So while dealers are in dealer capacity determine the supply side, the amount of contracts that and the prices that go into that side of it, the demand for hedging is in many ways equally important, maybe close to equally as important. It is very important to understand why people enter into these interest rate swaps to begin with. So let's break it down from the perspective of someone who's engaged and someone who's interested in getting into one of these contracts. So I said in the intro, it's fixed versus floating. And we'll talk about this from the perspective of someone who's receiving a fixed payment, which means you're going to be paying a floating rate. Because the swap contract is quoted based on the fixed leg, it's much easier to understand the dynamics of the situation from the perspective of someone who's receiving that fixed rate and paying the floating rate. Now, at inception, when we start out, the interest rate swap is set so that neither side is making any money, that the profit characteristics on both sides equal out. So the fixed rate is really set by market perceptions of what the floating rate is going to do. And the floating rate is really determined by future curves and future money curves. It's always upward sloping. We presume that interest rates through time are going to go up over time. And so that allows us to set this fixed versus floating pricing. So let's use a very simple example, a highly stylized illustration, so that we can conceptually understand what we're talking about here. So for example, let's assume that right now SOFR is at 0. And that over the next 4 years, it's going to go up in very easy linear increments to 4%. So that by the 4th year, SOFR is expected to be, and by expected, I mean the marketplace, the forward money curves all say that SOFR is going to go up in a perfectly straight line from 0 today to 4% by year 4. So if we want to equalize the fixed versus floating payments so that the contract doesn't make anybody any money on either side, at least at the inception, we're going to set the fixed rate. If we expect this floating rate curve to be 0 to 4 over 4 years, the fixed rate is easy. We'll just set it at 2%. And therefore, the cash flows that are exchanged between this fixed and floating rate roughly equal out. Because the fixed rate receiver, remember, we're looking at this from the perspective of the fixed rate receiver, you're making money in the first couple years of that contract because the fixed rate that you're receiving is above the floating rate that you're paying. So the first couple years, you're making money. But because we set the fixed rate at 2%, in the second couple years, the second half of that contract, you're actually losing money. You're losing money because you're still receiving the same fixed payment, but now you're paying a higher floating rate, or what you expect to be a higher floating rate in years 3 and 4. So from the perspective of both sides of the contract, at inception, it equals out. Now, in the real world, it's absolutely far more complicated. Because we've got to figure out the time value of money. You get rewarded up front for being a fixed rate player. There's compounding and cash flows to consider, the nonlinearity of real market curves, as well as probability functions, and a whole lot of other different variables. But setting all of those complications aside, you're looking at a situation where the fixed rate receiver has basically a zone of profitability and then a zone of losses. But we never stay as initial conditions. We're in a dynamic world, and so things are always changing, as well as starting with perceptions about the forward floating rate curve itself. So let's talk about the economics of interest rate swaps and how they're actually used, especially in hedging. So as I said, however long that floating rates are below the fixed rate, you're going to be making more profit. So if you believe that conditions are going to change such that interest rates are going to be lower overall than the current market is pricing what the current forward floating rate curve is, you're going to take that fixed rate option. Because if you believe that short-term rates, something's going to happen, that short-term rates are going to go down. Remember, we're talking about short-term money rates like SOFR. So anything that pushes interest rates down and holds them down for a prolonged period of time means you're going to win on the interest rate swap. Conversely, the opposite way, if you believe interest rates are going to go higher, then you're going to take the other side of the interest rate swap. So this is a hedging tool where it will pay off in certain circumstances according to how short-term interest rates behave. So whatever combination of short-term factors that push interest rates down, or longer-term factors that keep interest rates down for a longer period of time, that expands your profit zone and minimizes the loss zone for the fixed rate receiver. So it's a good hedging tool for interest rates that go lower over time. And those scenarios where interest rates go down over time, those tend to be when we confront recession, as well as in the case of the 2008-2009 crisis, the aftermath of that recession, where interest rates stayed lower for a very long period of time. So if you believe more than the market does that rates are going to go down, or the rates are going to go down and stay down, well, best of all, and you need that type of hedging against scenarios that would push rates down, use an interest rate swap contract. So obviously, the more there is demand for that type of hedging, the more people in the marketplace agree with you that something might happen. The probability of something pushing market rates down, short-term money rates down, is increasing. The more people that are going to demand to receive fixed from an interest rate swap. And the more people that demand to receive fixed from an interest rate swap, and fewer people who are willing to take the other side of that transaction, that means the fixed rate starts to decline. And as the fixed rate declines, especially relative to the nominal US Treasury yield that we're comparing it to for a swap spread, the swap spread gets bigger and bigger and bigger, increasing the swap spread, or in this case, making it more negative, compressing the swap spread. And as more and more people pile into those hedges, we get a stronger signal that the marketplace is becoming more and more concerned about that type of scenario. Not just a recession in the short run, but maybe a messy aftermath that holds interest rates down even longer in the longer term. So by comparing the fixed quote from the interest rate swap to the same maturity US Treasury, giving us a swap spread, it also gives us a sense of the relative changes on both sides fundamentally. We have the demand side where the increased demand for hedging because more and more people are believing that something's going to happen, which could probably lead to lower short-term money rates, not just in the near term, but maybe also in the future too. So higher demand for hedging against that type of scenario. And there's also the other side, the fundamental side on supply, what dealers are doing too. The swap spread gives us a sense of both of those highly, deeply fundamental properties that we can then use to interpret likely potential conditions moving forward. If more people are perceiving something that's going to happen, which would pay off with lower interest rates, that's something that we want to pay attention to, especially since there aren't all that many scenarios that lead to lower interest rates or keep interest rates low for a long period of time. That's why when we make these comparisons of fixed leg of interest rate swaps with nominal treasuries, therefore the swap spreads correspond very strongly to Eurodollar cycles, what we talk about with these deflationary, reflationary cycles ever since 2007, with Eurodollar number one being the global not financial crisis. So swap spreads, especially post the second half of 2008, swap spreads correlate with basically all of our Eurodollar indications, whether it be nominal US Treasury yields, the behavior there, oil prices, as I talked about in a recent video, yield curve shape on the Treasury curve, dealer holdings of US Treasury coupons giving us some insight into collateral indications. Basically, the swap market corresponds with all of those because the swap market is where it all really begins. It tells us about fundamental capacities as well as the demand for hedging. Swap spreads over the last couple months have been moving sharply lower, but they've been moving lower since last summer, really late August into September, preceding the bond rally. Now remember, swap spreads are not about long-term interest rates. Remember, they're tied to the floating rate, which is SOFR, short-term interest rate. So we're not hedging against scenarios where long-term bond yields are going lower. We're hedging against scenarios where short-term money rates are going lower. So the fact that we saw swap spreads sharply compressing last summer, late summer into the fall, suggested that as the bond rally was going, the lower growth and inflation expectations for longer term interest rates and longer term bond yields, there was also an increase in demand for hedging against the scenarios, recession scenarios, which would lead to short term interest rates going lower and staying lower. Those two developments naturally corresponded together as they have in prior Eurodollar cycles. So the market was hedging recession risks last year at the same time as bond rallies were going, consistent Eurodollar signal, as well as rising recession fears because increased demand for hedging, which would lead to short-term money rates going down. At the same time, growth in inflation expectations and the Treasury curve depressed interest rates, bond yields, longer-term bond yields. Since then, in 2024, the 5-year and 10-year maturity swap spreads, they paused. The 5-year maturity backed up a little bit over the couple months since the bond rally, but ever since May, the 5-year maturity swap spreads have been moving down again, suggesting increased demand for hedging as well as constraints in dealers in supplying that hedging. And the 10-year was mostly sideways this year up until around the middle of June. And it corresponded, the next leg down in the 10-year swap spread corresponded with the outbreak of election uncertainty in Europe. But while that has all calmed down, you can see the 5-year swap spread, the 10-year swap spread continue to depress and continue to get more and more negative, which suggests that maybe it wasn't really about Europe at all. And over the last couple weeks, the swap spread, the 10-year swap spread has hit a new record low, at least for its SOFR-based construction. It's about where it had been in LIBOR terms in March of 2020. It doesn't mean that the marketplace is thinking that we're going into the same type of disruption and disorder as in March of 2020. It's just that the hedging demand has increased so much that it has depressed these spreads to lows that are consistent with that level. It's a relative indication of the degree of demand for hedging against scenarios, which again, short-term interest rates go down and likely stay down. We've also seen it in the 30-year maturity, which has just been kind of steadily moving lower since last summer. Growing demand for hedging against short-term rates going lower and staying lower for a longer period of time. That's what the 30-year swap spread is kind of telling us. That the market is increasing hedging demand that will pay off when short-term money rates go down and likely stay down, increasing the zone of profitability for receiving the fixed rate payment for a long period of time. So that's a key negative signal as well, especially as the 30-year swap spread continues to hit lower and lower levels. So what we're seeing in the middle of 2024 is that interest rate swap spreads are making new lows, and some of them record lows, which is based on a couple of fundamental factors. One, the supply of money and dealer capacities and collateral and all that stuff on the supply side, but also, just as important, over here, the demand for hedging. Perceptions in the marketplace that maybe we need to hedge more against these scenarios that will lead to short-term money rates going down and maybe staying down for a lot longer, increasing the zone of profitability for when you're receiving fixed. Swaps and spreads tell us about supply considerations, dealer balance sheet capacities, which are incredibly important for understanding the health of the monetary system and its ability to continue to circulate money and credit and collateral and everything else. But spreads also give us a sense of hedging demand, the perceived dangers to the monetary system and the economy. The more that there is demand for hedging against scenarios that lead to lower for longer short-term rates, the fixed rate swap goes down and compresses the swap spread. And that's exactly what we've been seeing over the last several weeks, really last month. Swap spreads have been low and moving lower to begin with, and suddenly, over the last month, an increase in demand for hedging and maybe an increased inability of dealers to supply against it. So swaps are giving us strong warnings that are consistent with the recession signals that we're getting in the United States, the labor market and everything else, the European economy rolling over again, everything else that's happening in China that continues to happen to China, all of which potentially point to a global economic and financial climate in which short-term interest rates, short-term money rates go down and they stay down for a longer period of time. There's an increase in demand for hedging against the scenarios that would lead to those situations, and we're seeing those situations play out all over the world. If you want to know what's going on with the bull signals on the Treasury curve, I talked about those in yesterday's video. That's the one I've got linked below. As always, thank you very much for joining me. I hope you can join me next Tuesday for our live stream. Check out Eurodollar University's anniversary sale. And for all you members and subscribers out there, I cannot thank you enough. And until next time, take care.